Every once in a while, something happens in the stock market that completely changes the conversation. For decades, the go-to ETFs for investors were simple and familiar. If you wanted exposure to the whole market, you bought VOO, Vanguard's legendary S&P 500 ETF. If you wanted exposure to the fast-moving world of technology and innovation, you bought QQQ, the powerhouse tracking the Nasdaq 100. For many people, these two ETFs represented the best of both worlds, steady long-term growth, and explosive tech exposure. But recently, an under-the-radar ETF has done something shocking. It hasn't just kept pace with VOO and QQQ, it's outperformed them. It's taken the spotlight by doing exactly what so many investors dream of, capturing the winners, riding the hottest stocks in the market, and leaving behind the laggards. That ETF is the Invesco S&P 500 Momentum ETF, ticker symbol SPMO. Now, momentum is one of the most powerful forces in finance. And SPMO is built around this idea. Instead of buying every company in the S&P 500 like VOO does, or sticking with the tech-heavy Nasdaq like QQQ, SPMO chases the stocks with the strongest recent performance. It identifies the winners, concentrates on them, and doubles down on that momentum. And the results? Absolutely eye-opening. In certain years, SPMO has crushed not only VOO, but also QQQ, an ETF that many people thought couldn't be beaten. So in today's deep dive, we're going to break it all down. What exactly is SPMO? How does it work? Why has it been outperforming? What risks does it carry? And the big question, does it actually deserve a place in your portfolio? Over the next 60 minutes, we're going to go step by step, uncovering what makes this ETF so unique, why momentum can be such a powerful investing strategy, and whether SPMO might be the missing piece in your long-term wealth plan. Let's get started. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. To understand SPMO, we need to take a step back and talk about ETFs and indexes. VOO, as most of you know, tracks the S&P 500, the 500 largest publicly traded companies in the United States. It's broad, it's stable, and it's diversified across every sector. QQQ, on the other hand, tracks the Nasdaq 100, which is heavily tilted toward technology and innovation. Think Apple, Microsoft, Nvidia, Amazon, Meta. That's why QQQ has delivered incredible growth over the last decade. It was positioned perfectly for the tech boom. Now, SPMO takes a completely different approach. It doesn't track the whole S&P 500 equally. Instead, it tracks something called the S&P 500 Momentum Index. And what this index does is really fascinating. Twice a year, the index looks at all 500 companies in the S&P. It measures their momentum, which is basically their recent price performance, and then it selects the top-performing stocks. Once those stocks are chosen, the index rebalances to overweight the companies that have been the strongest performers, and it underweights or completely removes the weaker ones. In other words, it's not interested in being fair. It doesn't want exposure to everything. It only wants exposure to what's hot right now. Think of it this way, VOO is like owning every single player on a sports team, from the superstar down to the benchwarmers. QQQ is like owning only the flashy, high-scoring players from the tech league. But SPMO? SPMO is like owning just the players who are on a hot streak. If a player's been dominating the last few games, they're in. If they've been slumping, they're out. This creates an ETF that is dynamic, constantly shifting, and focused on capturing the strongest momentum in the market. And because of that, its holdings can look very different from VOO or QQQ at any given time. For example, during the massive surge in technology and artificial intelligence stocks, SPMO became heavily weighted toward Nvidia, Microsoft, Meta, and other high-flying names. But in other periods, when energy or financials outperformed, SPMO tilted toward those sectors instead. This flexibility, this willingness to chase winners, is what gives SPMO its edge. And it's also what makes it riskier, because momentum can work brilliantly in some market cycles, and fail dramatically in others. Now that you understand what SPMO is and how it's constructed, let's move on to the big question: how has it actually performed? Because this is where things get really interesting. Nobody cares about strategy unless it delivers results. And this is where SPMO really surprised investors. It didn't just work in theory, it worked in practice. Let's rewind for a moment. For years, the default answer to the question "what's the best ETF?" was simple: VOO for safety, QQQ for growth. But recently, when you compare their returns against SPMO, something shocking happens. Over the past few years, SPMO hasn't just matched QQQ's growth, it's actually outperformed both QQQ and VOO. Now, remember, QQQ has been one of the most successful ETFs of all time. It captured the rise of Apple, Microsoft, Amazon, Nvidia, and the entire digital economy. So for another ETF to beat QQQ, that's a big deal. But here's why SPMO managed to do it. Momentum strategies thrive during bull markets, especially when a handful of stocks are driving the majority of returns. And if you've been paying attention since 2023, you know exactly which stocks I'm talking about: Nvidia, Microsoft, Meta, Apple, Broadcom, Amazon, the so-called Magnificent Seven. VOO, because it owns all 500 companies, spreads its weight across winners and losers. That means while Nvidia was tripling in value, VOO was also holding underperforming banks, slow-moving utilities, and struggling retailers. QQQ did better, since it's tech-heavy, but it still had exposure to companies that weren't running as hot. SPMO, on the other hand, said, "Forget the laggards." It tilted aggressively into those top performers. And that decision paid off in a big way. Take Nvidia as an example. When Nvidia became the face of the AI revolution, its stock exploded. SPMO rebalanced into Nvidia, and gave it an outsized weight compared to what it had in the S&P 500 or even QQQ. That magnified the gains. Now, let's look at numbers. Over a recent multi-year stretch, VOO returned about 11 to 12% annually, QQQ returned about 15% annually, and SPMO topped them both, at times pushing returns even higher than 17%. And that's the story of SPMO, it shines when markets have clear winners. But here's the key point: this outperformance doesn't happen all the time. There are years where SPMO will lag behind. For instance, in 2022, when markets were in turmoil and winners quickly became losers, momentum got whipsawed. SPMO underperformed. So the lesson here is clear. If you bought SPMO in the right cycle, you were rewarded handsomely. But if you bought it in the wrong cycle, you might have been disappointed. Still, the fact that an ETF like SPMO has been able to outperform giants like VOO and QQQ at all shows just how powerful momentum can be. By now, you can see why SPMO has been generating so much attention. Its performance, its adaptability, its ability to capture the hottest stocks, all of these make it exciting. But before you get carried away, we need to have a very real conversation about the risks. Because momentum, while powerful, can also be dangerous. Risk number 1, volatility. First and foremost, SPMO is more volatile than funds like VOO. Why? Because it's concentrated. Instead of holding all 500 companies in the S&P like VOO, it holds a smaller, momentum-driven slice. That means its returns swing harder, both up and down. For example, when momentum stocks like Nvidia and Meta are soaring, SPMO flies higher than the market. But when those same stocks hit turbulence, SPMO falls harder. Investors who aren't comfortable with bigger drawdowns might find themselves panicking at the wrong time. Risk number 2, turnover. Another major risk is turnover. VOO barely changes, companies only get added or removed from the S&P 500 occasionally. QQQ rebalances quarterly, but it still sticks to the same 100 Nasdaq giants. SPMO, on the other hand, reshuffles its portfolio every 6 months. It dumps losers and piles into winners. That constant reshuffling creates more trading activity, which increases transaction costs inside the fund and makes it less tax efficient for investors. Risk number 3, expense ratio. SPMO also isn't as cheap as its rivals. VOO's expense ratio is an incredibly low 0.03%, essentially free. QQQ costs about 0.20%. SPMO sits at around 0.13%. That's not huge, but over decades, those costs can add up. If you're the type of investor who loves minimizing fees, SPMO isn't the absolute cheapest option. Risk number 4, cyclical performance. This is a big one. Momentum doesn't work all the time. It's cyclical. In bull markets, momentum crushes it. But in sideways markets or sudden reversals, momentum gets whipsawed. Take 2022, for example. The market went from growth-led to value-led almost overnight as interest rates spiked. Momentum funds like SPMO, which had loaded up on high-flying growth names, suddenly got hit hard. By the time the fund rebalanced, much of the damage was already done. That's the danger of momentum. It works brilliantly when trends are strong and stable, but it struggles when trends break down. Risk number 5, concentration risk. Finally, let's talk about concentration. At times, the top 10 holdings of SPMO make up nearly half of the entire ETF. That means if just 2 or 3 of those stocks stumble, the whole fund suffers. Compare that to VOO, where the top 10 holdings are only about 30% of the fund, or QQQ, where it's high but still more balanced. This concentration risk can create incredible upside, but it also exposes you to sharp downside. Now, none of these risks mean SPMO is a bad investment. They just mean you need to understand what you're buying. This isn't a steady, slow and steady fund like VOO. It isn't even a predictable growth machine like QQQ. It's a tactical play, designed to ride momentum wherever it goes. That makes it powerful, but also dangerous if you go in blindly. So here's the real question: with all these pros and cons, is SPMO actually better than VOO and QQQ? Or is it just a short-term winner that looks good today but won't stand the test of time? That's exactly what we'll explore next. So, let's recap everything we've learned today. The Invesco S&P 500 Momentum ETF, SPMO, isn't just another ETF. It's a tactical, momentum-driven fund that focuses on the strongest performing stocks in the S&P 500. By doing this, it has been able to outperform traditional powerhouses like VOO and QQQ during certain periods. We explored how SPMO works, why momentum investing can be so powerful, and how this ETF actively shifts into winners to capture outsized returns. We also looked at its risks, higher volatility, concentration, turnover, and occasional underperformance during trend reversals. Compared to VOO, SPMO is more aggressive; compared to QQQ, it's more flexible. And the truth is, whether it's better depends on your investing goals, your risk tolerance, and your time horizon. For some investors, SPMO can be a game changer. For others, it may be a supplement to a core portfolio of VOO and QQQ. The key is understanding what you're buying, why it works, and when it works best. So here's my question to you: would you add SPMO to your portfolio, or do you prefer sticking with tried and true ETFs like VOO and QQQ? Drop your thoughts in the comments below. I read every single one. If you found this video helpful, give it a like, hit subscribe, and turn on notifications so you never miss a deep dive into ETFs, stocks, and strategies that can help you build wealth smarter and faster. Thanks for watching, and remember, knowledge is your most powerful investing tool. Stay curious, stay disciplined, and always keep learning.